Two people invested $50,000. One buys real estate. The other buys index funds. 10 years later, one of them quietly becomes wealthier, and it's probably not who you think. Everyone online wants a simple answer to one question: real estate or stocks? Which one actually builds more wealth? Which one is the smarter move? The internet treats this debate like there's a single correct answer. Real estate people act like stocks are fake paper assets. Stock investors act like landlords are signing up for voluntary suffering. But the truth is much more interesting than that, because most people comparing these investments are comparing fantasy versions of both. They compare perfect real estate against average stocks, or average real estate against perfect stock market returns. Almost nobody compares the real-life versions honestly. So let's do that. Jake and Marcus are both 25 years old. Same city, same salary, same starting point. They both make around $55,000 per year. Both saved $50,000. Both want financial freedom. Both spend hours watching finance videos online trying to figure out the smartest path forward. But they make completely different decisions. Jake buys real estate. Marcus buys index funds. And over the next 10 years, their lives begin moving in completely different directions. Jake uses his $50,000 as a down payment on a $250,000 property, a 3-bedroom house in a decent neighborhood, a 30-year mortgage at 7% interest. After taxes and insurance, his monthly payment lands around $1,330. A few weeks later, he finds a tenant willing to pay $1,800 per month. The math feels incredible. Jake immediately starts calculating profit in his head. $1,800 coming in, $1,330 going out, almost $500 a month left over. Passive income. At least that's what he thinks. He feels like he made the smarter decision instantly. He owns a real asset now. Something physical. Something visible. He has a property. He has keys. He has tenants paying down his mortgage every month. He drives past the house sometimes just to look at it and thinks, that thing is making me money right now. Meanwhile, Marcus takes his entire $50,000 and invests it into a low-cost total stock market index fund. No leverage, no tenants, no property tours, no mortgage approval process, no late-night contractor calls. He sets up an automatic contribution of $300 every month and basically does nothing else. Nobody is impressed. His coworkers ask what he's investing in. He says, index funds. The conversation dies immediately. Jake has stories. Marcus has a brokerage account notification email. Emotionally, Jake feels like the clear winner. But here's the problem. Feeling richer and actually becoming richer are not always the same thing. And honestly, for the first few years, it really does look like Jake made the smarter decision. Rent checks keep arriving every month. The property slowly appreciates in value. He gets tax deductions from mortgage interest and depreciation. His tenant is paying off his mortgage. Everything about real estate feels productive. Marcus logs into his portfolio every few months and sees numbers moving slowly. Up a little, down a little, then slowly back up again. Year 1. Maybe his account grows from $50,000 to $55,000. Year 2. Maybe $61,000. Nothing about it feels exciting. No visible asset, no social status, no exciting stories to tell friends. Nobody asks Marcus about his index funds at dinner. This is where most people get psychologically trapped. Humans naturally overvalue visible activity and undervalue invisible compounding. A landlord feels rich much earlier. An investor usually becomes rich much later, and those are not the same thing. But now let's talk about the part every real estate influencer magically skips. Jake's $500 a month profit was never actually profit, because real estate math online is usually fantasy math. Most beginner investors calculate rent minus mortgage equals profit. That is not how reality works. The average rental property sits vacant for periods of time. Sometimes it's a few weeks. Sometimes it's months. Even 1 month without a tenant means zero rental income, a full mortgage payment, utilities, possible repair costs, cleaning, and listing the property again. Then there are turnover expenses, painting walls, replacing damaged flooring, deep cleaning, background checks, advertising, showing the property, time spent screening applicants. Then comes maintenance. And maintenance is where fake real estate profits begin collapsing. Every property is slowly breaking down all the time. Roofs age. HVAC systems fail. Water heaters leak, plumbing corrodes. Appliances die, driveways crack, fences rot. And these are not rare emergencies. These are guaranteed future expenses. Most experienced investors budget around 1 to 2% of property value every single year for maintenance and repairs. That means on a $250,000 house, thousands of dollars should already be mentally gone before Jake ever spends the money. Some years are easy. A leaking faucet, a broken garbage disposal, minor electrical work. Other years are financial nightmares. A $7,000 HVAC replacement in the middle of August because the tenant threatens to move out if the air conditioning is not fixed immediately. An $8,500 roof replacement after a storm. A plumbing issue that floods part of the basement overnight. A lawsuit because somebody slipped on ice outside the property. These things happen constantly. And then comes the risk that destroys some landlords completely. Bad tenants. One tenant who stops paying rent and understands the eviction process can destroy an entire year of cash flow. Evictions can take months, depending on the state. Meanwhile, the mortgage still exists. Property taxes still exist. Insurance still exists. Repairs still exist. And if the tenant damages the property before leaving, the costs become even worse. This is why experienced real estate investors spend enormous amounts of time screening tenants carefully. Because one bad tenant can erase years of small monthly profits incredibly fast. Suddenly, Jake realizes something. His passive income feels suspiciously similar to a second job. If he hires a property manager, there goes another 8 to 10% of the monthly rent. If he manages it himself, he's answering phone calls at 10 p.m. while trying to eat dinner. Either way, it costs something. And after accounting for vacancies, repairs, maintenance, taxes, insurance, management, and unexpected expenses, Jake's actual return is nowhere near the number he bragged about at the barbecue. At this point, you might think Marcus clearly made the smarter decision. But this is exactly where the conversation gets more complicated. Because, despite all these headaches, real estate still has one massive advantage that stocks struggle to compete with: leverage. Marcus used $50,000 to control $50,000 worth of assets. Jake used $50,000 to control a $250,000 property. That changes everything. Because if property values rise 4% annually, Jake benefits from appreciation on the entire property value, not just his original investment. And over time, that becomes powerful. His property slowly climbs in value. His mortgage balance slowly falls. His equity keeps growing. Rent prices slowly increase, while his mortgage payment stays relatively fixed. Inflation actually helps him because the debt becomes easier to pay over time. There are the tax advantages. Depreciation allows real estate investors to reduce taxable income, even while the property itself is appreciating in value. Through strategies like 1031 exchanges, investors can defer capital gains taxes by rolling profits into larger properties. These are legitimate advantages. This is why real estate creates so many wealthy people. But stocks have a weapon that feels boring at first, until it becomes almost unfair: compounding. And compounding is incredibly boring in the beginning. That's why most people quit before it becomes life-changing. Marcus keeps doing the same thing every month. No stock picking. No market timing, no stress. He keeps investing consistently while barely thinking about it. Then something interesting starts happening. The gains on his investments begin generating gains themselves. The curve starts bending upward. Eventually, his portfolio starts growing more from investment returns than from his actual contributions. His money begins working harder than he does. And unlike Jake, Marcus is diversified across thousands of companies instead of one property in one neighborhood with one tenant stream. No emergency repairs, no midnight phone calls, no lawsuits, no concentration risk tied to a single zip code. And here's the craziest part of this entire debate. By year 10, Jake and Marcus can both end up wealthy. Jake may even be slightly ahead because leverage can dramatically accelerate wealth creation during strong housing markets. But Jake also spent years managing properties, handling stress, carrying debt, and actively maintaining his investments. Marcus spent almost none of his personal time managing investments. This is the part people miss when they argue online about which investment is better. The real answer is that both work. Real estate wins in specific situations: strong rent-to-price ratios, smart leverage, house hacking, long-term appreciation, and efficient management. Stocks win in others: passive investing, diversification, liquidity, simplicity, and stress-free investing and compounding. The people who actually build serious wealth usually stop treating this like a war. They use both. They let index funds quietly compound in the background, while strategically using real estate for leverage, cash flow, inflation protection, and tax advantages. Because true wealth is not built by chasing one magical investment. It's built by understanding the full cost of every decision, not just in dollars, but in time, in stress, in risk, and in the life you want your money to create. If you enjoyed this video, subscribe to Finance Infrastructure for more deep dives into money, markets, investing, and the systems quietly shaping the modern economy.